In this video, I want to talk about risk management. Risk management concerns what you need in place today in case something seriously negative happens in the future. I break risk management into two general areas: emergency funds and insurance. An emergency fund refers to resources you have in case your primary source of income disappears. That is, what resources do you have available to you if your paycheck suddenly stopped due to being laid off from a job? Generally, it is recommended one have 3 to 6 months worth of living expenses set aside as an emergency fund in a checking or savings account, which can be quickly accessed. Is 3 to 6 months the correct range? The way I think about it is to assume I just lost my job and that is likely to have occurred during a difficult economic period, such as during a recession. How long would I expect it to take for me to apply to jobs, perform job interviews, get a job offer, and start the new job? That is the length of time you should plan for in building an emergency fund. You can also consider other sources of funds besides just a checking or savings account. For example, do you want to assume you will be eligible for state and federal unemployment benefits? If so, go to those websites and get a ballpark on what the monthly income will be and for how long. Also, if you took my recommendation to pay off your credit card balance every month, considering a credit card as a source of funds can be acceptable. Allowing the credit card bill to grow for a few months to cover groceries and other ongoing expenditures as you pay only the minimum required payment is a perfectly reasonable plan. Once you get the next job, you can then pay down the balance. The second area related to risk management is insurance. This is a topic that we could spend many hours on. I teach 2 college courses on insurance. And even in those courses, we can only really scratch the surface. But I will keep it very high level in this video. When discussing insurance, it is useful to break it into a few categories. First is insurance for property damage and liability exposures. Second is insurance for medical expenditures. Most get this insurance from their employer, and I'm not going to spend time on that as it is too huge of a topic to get into in this video series. But it is an important and unfortunately unnecessarily complex topic. Closely related to medical expense insurance is disability insurance, which provides income for people who are unable to work due to injury or sickness. This insurance is also usually provided by one's employer and will not be discussed in this video series. However, make sure you have a good coverage for both medical expenses and disability. Third is insurance for premature death. That is, dying earlier than expected while one is still bringing home an income to their family. Life insurance covers this risk very well. And fourth is insurance for the risk of living too long, or what is known as longevity risk. This is the risk one lives so long that their retirement assets are depleted. Social Security covers this risk to some extent as it pays an ongoing income that grows with inflation until a person dies. Some people also have a defined benefit pension plan from their employer that pays an income for life and often is adjusted for inflation. Pension plans are much less common today than in the past, as 401k plans are largely replacing them for most employers. I will discuss managing this risk in a later video. Before getting into the specifics, it is important to understand how insurance works. Insurance companies charge a premium to cover the claims they expect to pay out, plus it needs to cover an amount for their expenses, and finally, an amount to provide them a profit. It can vary dramatically between different types of insurance how much of the premium is expected to be paid out in claims. For auto insurance, 70% is common. That means if you pay $1,000 in premiums a year, you can expect, on average, to receive payments from the insurance company of $700. So on average, insurance costs you $300 more or 43% more than what you would expect to pay on average without the insurance.
So why buy insurance if it is expected to increase your costs, say 43%? The answer is that a major loss such as totaling a car can be so expensive that it seriously harms a family's financial situation. This is because these type of losses do not come evenly over time in an expected way, but tend to bunch up all at once via an infrequent and unexpected accident. Knowing this, one should use insurance prudently and to some extent sparingly, because insurance is increasing your costs, say 43%. Most people buy insurance based on what they have always done or what the insurance company recommends, but inertia is never a good strategy for buying insurance, and obviously the insurance company's sales representative has a strong incentive to sell you more insurance than you need. Now let's quickly cover property and casualty insurance. This insurance covers losses to your property and losses you cause others. The main insurance here is auto insurance and homeowners insurance. These are very competitive industries, so I recommend comparing rates between 5 major companies and going with the one with the lowest rate for the same coverage. Be careful on the deductibles and coverage limits because these will drive the premium. A deductible is what you pay before the insurance kicks in. The higher the deductible, the lower the insurance premium will be. Carefully selecting the deductible is very important for auto insurance and health insurance. One technique I like to use is what's called rate online, which is a measure of how much more premium is required to reduce a deductible. You are trying to find the sweet spot between a high enough deductible to keep the premium lower, but not so high as to be exposed to a larger than manageable loss. Here are some actual numbers I got from my insurer on my auto policy. Many insurers will allow you to do this analysis on their website. I compared premiums for 3 deductibles, $1,000, $500, and $100. Going from a $100 deductible to $500, the premium drops $139.80, or 34.95% of the additional $400 coverage. Moving from $500 to $1,000, the premium drops only another $46.56, or 9.31% of the additional $500 coverage. So you get much more bang for the premium dollar going from $100 deductible to $500 than from going from $500 to $1,000. I have my deductible set as high as possible, but if a $1,000 deductible is more than one can handle, $500 is probably the best option as it saves quite a bit in premiums. One would have to have an auto accident once every 3 years to make back the higher premium because one would be paying an additional $139.80 every year to get just $400 in additional coverage. The other issue for auto insurance is what specific coverages you need. This is beyond the scope of this video series, but I personally do not buy Parts B and C of auto insurance. These are uninsured motorists and medical coverages. One might think uninsured motorist coverage would be important in case someone without insurance hits my car. But without this coverage, I still have coverage for damage to my car from Part D coverage. Parts B and C are primarily health and disability insurance, coverages I already have from my employer. There are a few other items Parts B and C cover beyond health and disability, but those are not important coverages for me. I am not recommending eliminating Parts B and C from auto insurance, and your insurer will definitely make you feel stupid for asking about canceling it. However, I do strongly argue that you should never buy insurance if you do not fully understand what it covers and what it costs. Remember, when you buy insurance, you are paying 43% more than what it would cost you on average without the insurance. Make a list of all your property and casualty insurance coverages with the premiums, deductibles, and limits for each coverage. Then stop to ask if you are buying insurance for what you are most concerned about. The best way to do this is to test your coverage at the extremes. How will your homeowner's insurance perform if your entire house were destroyed? Do you have adequate coverage for its replacement costs to replace all of your personal items, including any unique and expensive items like jewelry or artwork? For parts B and C of auto insurance, ask your insurance provider to tell you exactly what the insurance will cover over and above your existing medical and disability coverages that you have from your employer. The items they might list will be pain and suffering, coverage for household expenditures like a cleaning person or daycare, the cost for a rental car while your car is being repaired. Then look at the premium for those coverages and ask if that is the best use of your insurance budget. Most people never think about the details of the property and casualty insurance they buy, but just keep buying the insurance they have always purchased. Remember, insurance by design is on average a losing transaction, so buy it wisely and be deliberate. Now to life insurance. This is where things get complicated very quickly and for all the wrong reasons. The life insurance industry struggled in the late 1970s when interest rates were very high. Their somewhat simple and boring products could not compete against products being offered by banks and investment firms. Rather than letting the industry shrink in a world that was changing, life insurers instead made a strong push to try to compete in this new world by offering new and very complicated products. Many of these products are quite awful, poorly designed, far too complicated, and terribly overpriced. How did they get away with offering such bad products? Well, by using a highly motivated sales force incentivized by huge commissions. The high commissions is one of the reasons these products are so overpriced, as insurers needed high premiums to cover the high commissions. These commissioned sales forces gave a distinct advantage to life insurance companies versus banks and investment companies. And given the complexity of the products, the sales representatives were able to hide the weaknesses of the products behind a screen of complexity. Life insurance is an important product for those supporting a family, but this coverage can be obtained at affordable prices without the complexity. My favorite life insurance product, especially for those age 40 or lower, is level term life insurance. A 10-year or 20-year level term life insurance product provides life insurance at a fixed premium for 10 or 20 years and at a low premium for young and healthy individuals. You have insurance protection when you need it, when you are still working and have dependents relying on your income. The other life insurance that can make sense is whole life insurance. This product provides life insurance for one's entire life at a fixed premium. It is more expensive than level term for the first 20 years, but the premium will not increase as one gets into their 50s, 60s, and later. I've seen many situations where having a whole life insurance policy was a major benefit to couples who failed to do a good retirement plan. The whole life insurance turned out to be a tremendous help to cover other planning mistakes. Starting a whole life policy before the age of 40 can be an unexpected benefit at just the right time later in life. Many people find out in their 70s that they did not save well for retirement, and if one spouse passes away, the other could be financially challenged. Having a, say, $200,000 or more life insurance payment come right at that point can greatly reduce the stress for the surviving spouse as they work out their financial situation going forward. Many couples completely forget they even have the policy as they pay the premium every month without thinking about it. But they remember when the time comes, and it is a tremendous stress reducer. I believe other life insurance products like universal life insurance, variable universal life insurance, and equity-linked life insurance are terrible products and should be avoided. They are extremely complicated, often far more expensive than fully explained by the sales representative, and come with truly horrible side effects if one changes their mind later and wants to get out of the policy. These products are so complicated, it is practically impossible to compare one company's product to another. With level term and whole life insurance, it is easy to compare products as one simply buys the one with the lowest premium. With these other products, there are so many complicated bells and whistles, Even someone with a PhD in mathematics would have a difficult time comparing products from different life insurance companies. Bottom line, with life insurance, keep it simple.